In January 2025, something happened that will cost the average American retiree approximately $47,000 over the next decade, and 90% of Americans have no idea it's happening right now. I'm not talking about a stock market crash. I'm not talking about inflation. I'm talking about something far more dangerous: the systematic abandonment of the dollar by countries around the world. And it just accelerated faster than any economist predicted because of a single military operation. Look, I need you to understand something. This isn't about Venezuela. Not really. Venezuela was just the trigger. This is about why 60% of low-income countries are now under U.S. financial sanctions, why that number is driving a global exodus from dollar-based systems, and why your retirement account is about to feel the consequences in very real, very painful ways. Because here's what nobody's telling you. When countries abandon the dollar, American purchasing power declines. Bond values drop. Social security funding gets more complicated. Everything priced in dollars, which is basically everything, becomes more expensive. And the Venezuela operation just gave every country on earth another reason to accelerate this trend. Let me show you what's happening right now at this very moment. Brazil's central bank just announced they're accelerating their de-dollarization timeline. They moved it up by 3 years. 3 years. Saudi Arabia, America's ally for 8 decades, is now accepting Chinese yuan for oil payments. That's a sentence that should never exist, but it's reality in 2025. The BRICS nations, Brazil, Russia, India, China, South Africa, they represent 45% of the world's population, and they're all simultaneously reducing dollar reserves. And this week, after the Venezuela operation, the phone lines between these countries have been burning up with discussions about one thing: how to insulate themselves from American financial pressure. Not how to cooperate with America. How to escape from America. This video is going to show you exactly how we got here, why the Venezuela operation was the breaking point, and most importantly, what it means for your money. If you have a 401k, an IRA, bonds, or any savings in dollars, what I'm about to explain directly affects your financial future. This isn't abstract geopolitics. This is your retirement security. Let me start with a number that should terrify every American: $47,000. That's approximately how much the average retiree with a $500,000 portfolio stands to lose over the next decade if de-dollarization continues at its current pace. And after Venezuela, that pace just went from gradually to rapidly. Let me show you why. Let's start with that 60% number because it's more important than people realize. According to 2024 data, 60% of low-income countries are currently under some form of U.S. financial sanctions. Read that again: 60%. That means if you're a developing nation, you're more likely to be sanctioned by America than not. Now here's where it gets interesting. The United States imposes 3 times as many sanctions as any other country or international body combined. More than the UN, more than the EU, more than China, Russia, and every other power combined. We've sanctioned Iran, Iraq, North Korea, Venezuela, Syria, Russia, Afghanistan, Yemen, Somalia, Sudan, South Sudan, Central African Republic, Democratic Republic of Congo, Libya, Lebanon, Nicaragua, Zimbabwe, Myanmar, Belarus. The list goes on and on. And here's the thing: sanctions aren't just diplomatic penalties, they're economic weapons. When you're sanctioned by the United States, you're cut off from the stub-your IFT payment system. You can't do business in dollars. You can't access international banking. Your country's financial system is essentially isolated from the global economy. For decades, this was accepted as just how the world works. America sets the rules, and everyone else follows them or faces consequences. But something changed. Countries started asking a very dangerous question: what if we just built a different system? And they did. China launched CIPES, the cross-border interbank payment system, as an alternative to a SCUIF. Russia developed SPS. India is building its own payment infrastructure. The BRICS nations are negotiating a common currency backed by gold and commodities. These aren't theoretical projects. These are operational systems processing billions of dollars in transactions right now. In 2024, 23% of global payments were processed outside the dollar system. That's up from 15% just 3 years ago. The trend line is unmistakable. And every time America uses sanctions, every time we weaponize the financial system, we give countries another reason to accelerate the development of alternatives. Venezuela was just the latest example. We didn't just sanction them, we bombed them. And every country watching asked themselves, if we're next, how do we protect ourselves? The answer is always the same: get out of dollar-dependent systems as fast as possible. Here's the strategic error that Washington keeps making. They think financial power is like military power, something you can use without consequences because you're stronger than everyone else. But that's not how economic systems work. Military power is about dominance. Economic systems are about trust and voluntary participation. When you weaponize a system people voluntarily participate in, they stop participating voluntarily. They start looking for exits. We thought sanctioning 60% of developing countries would maintain American dominance. Instead, we created a massive incentive structure for 60% of developing countries to build alternatives to American dominance. We armed our competitors with the perfect recruiting pitch: work with us, and you won't be subject to American financial threats. And it's working. But you might be thinking, so what? America is still the world's largest economy. The dollar is still the reserve currency. How does this actually affect regular Americans? Let me show you exactly how, and I warn you, the numbers are not going to be comforting. Let me explain how the dollar system works, because most Americans don't actually understand the mechanism that keeps their money valuable. The US dollar is the global reserve currency. That means countries around the world hold their savings in dollars, typically as US Treasury bonds. Why? Because for 70 years, holding dollars has been safe, stable, and liquid. This creates enormous demand for dollars and for American debt. And that demand has three critical effects that benefit every single American. First, the dollar stays strong. When everyone wants dollars, dollars are worth more. That means everything you buy from overseas, electronics, clothing, food, gas, is cheaper than it would otherwise be. Your purchasing power is artificially elevated because of global demand. Second, interest rates stay low. When everyone wants to buy Treasury bonds, the US government doesn't have to pay high interest rates to attract buyers. That means cheap mortgages, cheap car loans, cheap business loans. The entire economy runs on cheaper credit. Third, bond values stay high. If you're retired or near retirement, a huge chunk of your portfolio is probably in bonds. Those bonds maintain value because there's consistent global demand for them. This system has been the foundation of American prosperity for generations. And it's starting to collapse. Here are the numbers, and I need you to really hear this. In 2000, 71% of global foreign exchange reserves were held in US dollars. By 2024, that's down to 58%. We've lost 13 percentage points of global reserve status in 24 years. That might not sound dramatic, but let me put it in perspective. Every 1% decline in dollar reserves represents approximately $130 billion in reduced demand for US currency and bonds. We've lost 13%. That's $1.7 trillion in reduced demand, and the trend is accelerating. We lost more in the last 3 years than in the previous 10. What does this mean for you specifically? For the dollar's value, a conservative estimate suggests the dollar could weaken by 10 to 15% over the next 5 years as de-dollarization continues. That means everything imported becomes 10 to 15% more expensive. Gas, food, electronics, medicine. If it comes from overseas, you're paying more. For interest rates, as demand for Treasury bonds falls, the government has to pay higher interest rates to attract buyers. The 10-year Treasury yield could increase by 1 to 2 percentage points. That doesn't sound like much, but it means mortgages become more expensive, car loans cost more, credit card rates increase, business investment slows. For bond values, here's where it gets really painful for retirees. When interest rates rise, existing bond values fall. It's an inverse relationship. If you have $500,000 in bonds in your retirement portfolio, a 2 percentage point increase in interest rates could reduce the value of those bonds by approximately $100,000. $100,000. Gone. Not because you made a bad investment, because the global financial system is shifting away from dollar dependence. This is what people miss about geopolitics. It's not abstract. It's not just about countries and militaries and diplomatic statements. Every foreign policy decision America makes has direct consequences for American wallets. When we sanction countries, when we weaponize the financial system, when we bomb Venezuela, these actions don't just affect foreign governments. They affect your retirement account. Because every time we give countries a reason to move away from the dollar, we weaken the entire system that's been subsidizing American prosperity for decades. We've been living with an invisible subsidy. The world's demand for dollars has made everything cheaper for Americans. We can import goods at artificially low prices. We can borrow money at artificially low rates. Our government can run deficits that would bankrupt any other country. And we've gotten so used to this subsidy that we don't even notice it anymore. We think this is just how the economy naturally works. But it's not natural. It's the result of a specific system built over 70 years. And that system is breaking down because we keep using it as a weapon. Now, you might be wondering why Venezuela? Why did that operation specifically accelerate this trend? To understand that, I need to show you what China did while American bombs were falling. And it's brilliant, ruthlessly, strategically brilliant. January 4, 2025. U.S. airstrikes hit military targets around Caracas. Maduro is arrested within hours. American officials brief the media about the successful operation. And while this is happening, Chinese diplomats are making phone calls, lots of phone calls. Not to condemn, not to threaten. Just to listen. They call Brasilia. They call Bogota. They call Mexico City. They call Lima, Buenos Aires, Santiago. And in every conversation the message is subtle but clear: we would never do this to you. We respect sovereignty. We offer partnership, not threats. Within 48 hours, China's foreign ministry releases a statement. It's carefully worded, diplomatic, designed to sound reasonable. They condemn the operation as a violation of the UN Charter. They call for dialogue and respect for Venezuelan sovereignty. They position themselves as defenders of international law. And then the really smart part happens. Chinese media doesn't have to exaggerate American actions or make up stories about imperialism. They just show the footage. American planes bombing Caracas, Maduro in handcuffs. Latin American leaders expressing outrage, U.S. officials defending the operation without UN authorization. The propaganda writes itself. And alongside this footage they run a split screen. On one side, American military operations. On the other side, Chinese engineers building infrastructure in Ecuador, Peru, Brazil. Bombs versus bridges. Threats versus trade deals. Instability versus investment. The impact was immediate and measurable. Within 1 week, 4 Latin American countries accelerated negotiations with Chinese firms for infrastructure projects. Brazil's government publicly announced it would increase trade in yuan. Mexico's central bank confirmed discussions about bilateral currency arrangements. BRICS held an emergency meeting to discuss financial security and independence. But the real impact shows up in the financial data. In the 2 weeks following the Venezuela operation, foreign purchases of U.S. Treasury bonds declined by $23 billion. BRICS central banks increased gold purchases by 40%. Alternative payment system transactions spiked by 18%. The dollar weakened against a basket of currencies by 1.3%. These might seem like small numbers, but at this scale they're enormous. A $23 billion decline in Treasury purchases in 2 weeks. That's not normal market fluctuation. That's countries making strategic decisions to reduce dollar exposure. And the trend is continuing. Every data point since then shows acceleration. Here's what's so darkly ironic about the Venezuela operation. It was supposed to demonstrate American strength and resolve. It was supposed to send a message to China and other adversaries: this is our hemisphere. We will not tolerate challenges to our interests. But the actual message received was completely different. What Latin America heard aligned too closely with the United States, and you might be next. What global investors heard: dollar-based assets carry geopolitical risk. What China heard: keep doing exactly what you're doing because America is defeating itself. Every bomb that fell on Caracas was an advertisement for Chinese financial alternatives. Every image of Maduro in custody was a reason for countries to diversify away from dollar dependence. Every statement from U.S. officials defending the operation without UN authorization was proof that international law doesn't constrain American power, which means it doesn't protect anyone from American power. But let's get specific, because I know some of you are thinking, okay, the dollar might weaken a bit, bonds might lose some value, but I'll be fine. Let me show you exactly what's coming and why fine is not the word I would use. Let me walk you through what's about to happen in 3 distinct phases. And I need you to understand, this isn't speculation. These mechanisms are already in motion. Wave 1 is the immediate impact, happening right now through the next 12 months. Countries are actively reducing dollar reserves and treasury holdings. Every month, central banks worldwide are selling billions in U.S. bonds and buying alternatives: gold, yuan, euros, even cryptocurrencies. What you'll see in the next year: gas prices gradually increasing even without oil supply disruptions. Import prices rising across the board, electronics, clothing, food, interest rates staying higher than expected despite Federal Reserve policy. Bond values in retirement accounts showing consistent small declines. It won't be catastrophic yet, it'll be subtle. Your portfolio loses 3% here, 4% there. Gas goes from $3.50 to $4. Your grocery bill increases by $30 per week. You'll blame inflation. You'll blame the government. But the real cause is de-dollarization, and it's just beginning. Wave 2 is the structural shift, 1 to 3 years out. This is when the pain becomes undeniable. As more countries successfully operate outside dollar systems, the network effect that sustained dollar dominance starts reversing. What happens? A major oil exporter, likely Saudi Arabia or UAE, announces it will accept multiple currencies, effectively ending the petrodollar system. Treasury bond auctions start failing, meaning the government can't sell all the bonds at the interest rates they want to pay. The Federal Reserve is forced to raise rates dramatically to attract buyers. The dollar loses another 8 to 12% of value against major currencies. For you, this means that $500,000 retirement portfolio is now effectively worth $430,000 in purchasing power. Fixed income from bonds doesn't cover rising costs. Social Security discussions start including words like sustainability crisis. Anyone on a fixed pension is seeing significant reduction in living standards. You're not bankrupt, but you're noticeably poorer. Retirement plans get delayed. Lifestyle adjustments become necessary. Dreams of world travel get replaced with maybe we'll just stay local. Wave 3 is the systemic crisis, 3 to 7 years out. This is the phase nobody wants to talk about because it's genuinely frightening. By this point, alternative financial systems are mature enough that countries can mostly function without dollars. The BRICS currency is operational. Regional payment systems are interconnected. A large portion of global trade happens outside the dollar system. The US government faces a genuine fiscal crisis. We've been running trillion-dollar deficits for decades because the world bought our debt at low interest rates. When they stop, we have two options: spending dramatically, Social Security, Medicare, defense, everything, or print money and accept hyperinflation. Neither option is good. Both options devastate retirees. Let me put numbers on this because vague warnings don't help anyone prepare. If you're a 65-year-old retiree with $500,000 in a typical portfolio, 60% stocks, 40% bonds after wave 1 in 1 year, portfolio value effectively $475,000 after inflation adjustment. After wave 2 in 3 years, portfolio value effectively $420,000. After wave 3 in 7 years, portfolio value effectively $340,000. That's $160,000 in real purchasing power lost. Not because of stock market crashes or bad investments, but because the dollar system that underpinned your entire financial life is dissolving. And if you're dependent on fixed income, bonds, pensions, Social Security, it's worse. Because while your nominal income might stay the same, your purchasing power collapses. That $3,000 monthly Social Security check in 7 years, it might only buy what $2,100 buys today. Same number on the check, completely different quality of life. Here's what's so brutal about this situation. It's not happening because of some natural economic cycle. It's not an asteroid strike or a pandemic or something beyond human control. This is a direct result of policy choices. We chose to weaponize the financial system. We chose to sanction 60% of developing countries. We chose to bomb Venezuela rather than pursue diplomatic solutions. And now we're all going to pay the price for those decisions. Every choice accelerated the timeline. Every action gave countries more reason to build alternatives. Every demonstration of American power undermined the trust that sustained American economic privilege. And now Americans, particularly retirees who planned their whole lives around dollar stability, face an uncertain future that nobody prepared them for. The real question is, are you prepared?